Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
All right. Welcome, Value Builder community. Today, I'm talking with Paige Gunn, Vice President at Sands Investment Group. Paige has been in commercial real estate brokerage for over 10 years, moved through Marcus Millichap, Transwestern, a few other firms. So right now, she's with Sands, and she closed over $370 million in industrial and office deals across Midwest. She has really good sense on that market and has tabs on industrial and office. We're going briefly to touch on her journey, and then I really want to get her 2 cents of what she sees in the industrial and office market in Midwest and Chicagoland, and where opportunities are and what's coming in 2026 and how does she see it. So welcome to the show, Paige. How are you?
Thanks so much. I'm doing great. Appreciate you having me on. Yeah, I mean, a little bit of my background started out right out of college. Was in Chicago for about 10 years, started on office predominantly, and that quickly moved right before COVID actually into more flex industrial. And then it's kind of been industrial moving forward. And I'm excited to be here. And I think there's continued growth in those paths continuously. I mean, industrial is always the topic of the day, right?
Oh, yeah. Yeah, it definitely became, it's probably not was the one you started 10 years ago, right? No, it was what I call radioactive.
Yeah.
2017, when I bought my first building, it was radioactive. When industrial was hard to get financing, it was, but not right now anymore. I'm curious, you started right away in Marcus Millichap, or you started at some other firm?
Yeah, Marcus was the first. So I was there in 2015 for about a year, and then moved straight over to Transwestern, was there for almost 7, and then was with Stream Realty Partners for a little bit, and then I made my way back to Texas, and now I'm with Sands Investment Group launching their multi-tenant, small bay, shallow bay industrial team.
So in Marcus, when you started right away, went investment sale as a broker. What did you do in Marcus right away?
So, I mean, everything.
Mm-hmm.
You do everything as a broker. But we did a lot of mixed use downtown, kind of that flexy, what we used to call flex, at least, was kind of the office, retail, mixed use properties, as well as a little bit of flex in the suburbs of Chicago, at least. Kind of that single story office, mixed use product type. Yeah. And it did well, but it was tough.
Yeah, it's interesting. I know the Texas flex and Chicago flex, it's 2 different properties. Right?
Oh, yeah.
I think, Chicago flex is like a mixed use almost. And Texas flex is the small bay industrial, the typical small bay industrial, right? No, it's different market, has different lingo.
Yeah. And I mean, I would say they even they're starting to call them contractor garages.
Mm-hmm.
With it's almost like a front end retail small bay product with a drive-in door, which to me is still small bay.
That makes sense.
But yeah, everyone has their own lingo to it. I think none of the product types are really new. It's just how they evolve, I think, throughout time and how people name them to be a little more specific.
Yeah, exactly. So one thing I want to touch on, I'm just curious, what was your biggest deal or most, either biggest or most, memorable deal when you worked in Chicago market? What was that, if you remember?
That was actually probably the Park City deal I did right before I transitioned, which was kind of an iOS in some capacity. It was more of a single tenant industrial deal on close to 9 acres. It was about 105,000 square feet. But I think I brought offers for that fully off market, by the way.
Mm-hmm.
I think I brought offers, maybe 3 or 4 offers 2 years prior. It took me 2 years to get that deal done. Ultimately,
and why is that? Because Silla didn't took it, or it was challenging to close financing, city? What was that? Permits?
All of it. I would say all of the above. I mean, there was a shorter term lease. There was whisper in the market that the tenant was going to be vacating, but they still had enough term on there. Seller wanted a little bit more. It was a little bit more of a, it was potentially like an iOS coverage type play where you had 2 buildings, you could potentially multi-tenant it at some point. You would hope that the tenant would stay. Very strong credit, very known, tenant mix there. But yeah, ultimately we ended up closing, I think, $5 million below what the original offer prices were, and where those offers came in originally, we just couldn't get the financing. It just wasn't a lot. Yeah.
Makes sense. That makes sense. Awesome.
But it was a great deal. I mean, overall, I think it's a strong product, and getting that north market and kind of north of, Lake Forest is a little tough. You're close to Wisconsin. So,
What, that was Lake County?
yeah, it was Lake County up in Park City, Illinois.
Yeah, for a couple of deals in Lake County. Yeah, it's a little tougher to move in Lake County, at least right now.
Yeah.
All right, awesome. If I may, I would like to transition to talking about Chicago and Midwest, what's happening right now. So let's talk first Chicago industrial market. What are you seeing right now heading in 2026? I see a little bit softness in leasing. I think it coincidentally just picked up, in the last few weeks. Now I don't know why, because we're pushing more marketing. It's aside of that, because I just said, what do you see in industrial market right now in Chicagoland or Midwest overall?
Yeah. I mean, I think Chicago is always going to be a hot market, right? I mean, it's one of the top and largest industrial markets in the United States. But I do see a lot of buyers and clients of mine are starting to stretch outside of the Chicagoland area. I mean, you're starting to get those political and issues, I think, just overall with taxes and how those are assessed. I think that's always been a topic. And I'm starting to see some of those groups really stretch into these secondary, some primary, but secondary markets. I mean, I think Ohio's been a really big hitter. I think Minneapolis has a lot of momentum out there, especially for kind of flex, light industrial, even single story office that has the functionality that could be, I think, transferred into more traditional light industrial at some point, kind of during a hold period. So we're seeing a lot of that movement, but I do think that there's always going to be volume and velocity. Mm-hmm. And I think it's just a matter of where are the seller's pricing expectations, and can you go buy something outside of Chicago, looking into Indy, Cincinnati, Columbus, Minneapolis, even, some people starting to stretch into Des Moines. Mm-hmm. And Omaha and some of these other markets where you can get significantly lower basis or better yield on cost in general and have a better steady cash flow.
Do you keep tabs on leasing after you acquire for your buyers? How are they doing on leasing velocity compared to Chicago? Obviously, Chicago is comes with the benefit that we have such a hub of logistics, right? And there's always activity in terms of tenants, even though it's slowed down. Then we have to deal with the Cook County taxes, and that's another podcast by itself, right?
Yeah, right.
But going back to do you see the leasing velocity holds in those tertiary markets right now, or it's got much softer? What's your take on it?
I mean, honestly, I don't track it as much as I probably could, just from a day-to-day time perspective. But I think that, all of those deals are doing really well. I mean, I think the buyers come in with the anticipation that it's a value add play. I can't necessarily jump rents immediately, but there's a way the supply is so constrained in a lot of these markets, especially for that small bay, shallow bay flex mm-hmm. product, call it sub 10,000 square feet. And that demand, where are they going to go? Mm-hmm. But, so that velocity is there. It's just in a timely fashion, I think, of how do you turn over those tenants without fully vacating it and hoping you can get the rents that you're trying to achieve. And that's where we're seeing kind of the momentum in these markets, where you can still kind of do month to month or short term and keep that cash flow steady, and that velocity is still going to be there. You just have to get these tenants to be willing to kind of recoup those costs into their business.
So what you're saying, to keep the tenants month to month, even post acquisition?
Yeah, we're seeing a little bit of that just from a short term while they figure out their kind of execution plan and mm-hmm. and how they're going to do that. And maybe it's a focus on certain tenants, or trying to dial back some of the office on the vacancies, mm-hmm. Other components that can keep some cash flow in play so that they're not, sitting with potentially a vacant building, hoping to, go from $9 gross to $18 net.
Mm-hmm. Yeah, totally. Yeah. And that's that I've been seeing definitely in our market. I think the biggest jump probably was between like 2022. Well, literally we saw double the rents. I remember, Florida when we bought, we stabilized it at $13-14 a foot triple net, and we thought it's the top. And we sold it over there. And 2 years later, I see comps of almost like $18 a foot. It's really above retail, which is like shocking, right? It's really shocking that it's renting some places more than retail spaces.
Well, and that's the question of how people define small bay too, because you're getting these retail tenants in there as well
Mm-hmm.
that are utilizing the space very similar. So at some point, it's like, okay, are you going to go get a retail space for 25 net, or do you
Mm-hmm.
need that drive-in door? And that's where that high teens makes sense.
Mm-hmm. Totally makes sense. Totally makes sense. All right, now cap rate question. Are you seeing finally cap rates compressing back after those couple movements of the rates, or they're still, still not up there? I would say, I'll let you speak and I'll see what I see.
Yeah. I mean, I don't think honestly, I think cap rates on value. I mean, most of what I do is value add and opportunistic. I mean, I think you can see it a little bit on the core deals and core plus, but I don't know a lot of people looking at cap rates these days. I mean, it's really basis and yield on cost driven. Someone could say that they bought something for 7 cap, and then you actually take out the acquisition costs and everything from the legal and the PSA, everything you have to do to even get that transaction closed.
Mm-hmm.
That's actually not a 7. You're probably looking at a 6.5. You've always been looking at cap rates that are slightly lower than what are
Yeah.
actually put out to the market. And I don't think that that's really changed that significantly. I think there's the hope. And I think that there's a lot of 1031 buyers out there that could still maybe buy stuff for a lot cheaper and aren't really looking at cap rates because they have another motivation.
Yeah. I mean, and I definitely agree with that on the value add side. I'm just looking at what the exit cap, let's say after refi or takeout cap, within 2 years. If the notion that we're going to be decreasing that or we're still staying, I'm still underwriting between 7-8 caps exits.
But yeah, that's everyone. And I think that's how I underwrite anything I'm even pitching to sell or for everyone. I don't foresee that moving until we see more numbers on the board that are showing otherwise.
Mm-hmm.
It's going to be that, we need another 2019 in Chicago.
Yeah.
And like where you're seeing those drops to like 4.25 or below for people to really start.
Yeah, I call it Disneyland times, and I've seen those. So look at those comps right now. How did this happen?
It's crazy. And I mean, they didn't change that much after. I mean, they were still sitting pretty kind of in those low 4s. And you saw it in DFW kind of in the 3.5, 3.7 for some stuff. And it was pretty crazy. But I mean, at the end of the day, who's actually exiting at those? Like, that's the goal. But I mean, you're really functionally looking at those deals still between a 7 and an 8. Some aggressive groups, maybe high net worth family office or again 1031s can kind of look at like an exit at a 6.5 maybe instead of that 7, but even that's pushing it, I think, still.
Yeah, for sure. Yeah, so I'm glad. I'm glad to see that I get a sense that you're fairly bullish on small bay industrial, which I'm the space in right now, and that's great to hear that it's the same notion. Now, what do you think about demand on small bay industrial? Yeah, it's becoming more popular for maybe call it more institutional type of buyers. I think it's getting more familiar. I get that. But also, what other demand do you think drives? In the past, I think it was e-commerce. Do you think there's some other demand from, I'm coming back to leasing, what still drives the small bay industrial? And it's still kind of, still hot?
Yeah, I mean, that's always going to be, service based businesses, anything regional, anything that needs to be within a certain, call it a radius, I guess, of where they're distributing to and or where their other vendors or people are. I mean, we're seeing that kind of even in Northwest Arkansas and some other places in the South that aren't always looked at, but there's some, bigger companies. I mean, Houston as well, and Decatur have some big launches for some, pharmaceutical companies. All those vendors are going to flock, and all of their other logistical related companies that just need to have, in order to do business with some of these companies, be within a mile radius, even if it's a 1,500 square foot or 3,000 square foot space where they can operate out of, have a few, offices and some level of a warehouse where they can have something. And I think that, that's going to be a continued growth strategy. And you can get multiple layers of, that could be any business in the world, right? I mean, in today's society, anyone can start a business tomorrow. And if they need to be near somebody, it's going to be that driving demand. So it's just making sure it's attainable, it's reachable, it is accessible. If they need that visuality from the front end to bring their business in, that's where you get some of those retail mix type tenants. It's going to continue to boom. I think you just have to find the right product in the right markets. And, that we'll see where that basis goes and where that demand goes, but I don't see it tapering off anytime soon.
Every week, I read hundreds of commercial real estate articles from across the U.S. and around the world. I connect the signals, break down the Fed moves, and share real case studies, not theory, from my 2 decades of real estate experience and actively doing deals right now. My team and I spend 15 plus hours on a weekly basis and deliver this to you for free. You can read it in 5 minutes. So every Sunday at 9:07 a.m., you'll get major commercial real estate news that matters, one Fed insights that matters, one deep dive case study from me or one of our operators who already made the mistakes, so you don't have to. Thousands of commercial real estate operators and investors read this newsletter, especially in the value add space. And don't take my word for it. Check out hundreds of reader testimonials online. Plus, when you subscribe, you get instant access to a Proforma underwriting tool, the same one we use every single day to underwrite value add deals. Now, this is not for you if you're looking to get rich quick schemes, or if you're looking for theory and hallucinations, not real numbers, or you're not serious about commercial real estate. But if you want real tactics, real deals, real results, no bait and switch, go to joinvaluebuilder.com and subscribe for free. And see you there, guys. Totally. Now, if you are an investor in 2026 looking at Midwest industrial right now, where you should be buying in Midwest? One market or two markets or three markets? What do you think? What's your hunch?
I think if anyone's willing to go outside of the secondary, you still have, I think, touching a little bit of those tertiary markets just outside the primary. Anywhere, again.
For example?
Like Des Moines, Omaha, some of these markets, they need fresh capital. They've been the same owners forever. That's going to have to rotate out, and you're going to be able to get really solid opportunities. There's not, minimal new development, minimal competition on some of the, I have a single tenant deal even out and right outside of Des Moines that has the ability to be multi-tenanted into small bay, and they have nowhere to go. There's no new supply at all in some of these markets, and you can really achieve those same yield on cost. So, I would say touching on some of those outside of, you're still drivable to Cincinnati. You're still drivable to Des Moines, to Omaha, to Indianapolis. I think Minneapolis may see another resurge, in my opinion, if you can rotate out some of that institutional REIT capital at some point.
Do you think in those tertiary markets, other institutional buyers who can take out, the way I see it, right? There is a smaller operators who will take and do a light value add, or maybe heavy lit, right? And then there is a institutional buyer comes in and buys bigger chunk of the properties. Are there buyers who will buy those tertiary markets, or is there appetite for that?
I think there will be. And I think that's the goal here, right? You at one point, as we even talk about small bay, institutional capital is not really there yet until they can aggregate it in a significant fashion or it makes sense from an operational standpoint. So I think if you're already functioning in these markets that are very close by, you don't have to add a whole nother person from the operations side just to be able to take on those. So I do think that once you can get some fresh capital in, have a new buyer, we're going to start seeing that those institutional players come in.
Mm-hmm. Makes sense. Makes sense. Yeah, maybe it's time to move a little bit further away from Chicagoland. We do have some properties in Ohio. We did well in Beaver Creek, Milwaukee too. Yeah, but never looked in Omaha. I mean, I've seen a few deals, but never put focus on it, like Omaha or Des Moines.
Yeah, and I mean, some of them, it's the right fit for your portfolio, right? I mean, not every market in the Midwest is going to align with what you already have. But I mean, if you can aggregate a few deals for a really good basis that's going to give you, a 2-3x multiple or more, and you can kind of have your own little, call it like a mini portfolio in these pockets and operate that way, I think how does it not make sense? You just have to get that write-off, and that's where we're not seeing the institutional capital, I think, write-off on those deals because they haven't transacted there. So you have to go through their boards and everybody that wants to sign off. They want to be in the primary markets.
Exactly.
But everyone's getting bought out of the primary markets. They can't even get bids in at this point.
Yeah, totally makes sense for sure. The inventory is very tight. All right, now let's transition to office because I know we have experience in that one and we have a good feeling about what's going on. Chicago market obviously was devastated. It's all over the media, especially downtown. I have a feeling that the suburbs bounced back, probably bounced back a little long time ago. But where do you see Chicago office market? Do you think we hit the bottom? We're still looking for the bottom in downtown. It's fractionalized. Where do you see what's going on?
I mean, it's definitely it's gonna be, I mean, you're talking about a massive office market down there, and I probably am not the best person to speak on the entirety of downtown and where that sits today. But I would say everyone's always looking for a bottom. Everyone has been trying to push themselves out of these long-term loan struggles for a long time, and they've bought themselves more and more time. There's going to be a fold there. And I think the suburbs hit it even harder at first and rebounded a little quicker. And I think single-story office in the suburbs is probably going to pick back up rapidly. I mean, I think that's going to be the way that people can go in and maybe buy cheap price per square foot deals that are single-story office and see if they can punch out some drive-in doors. See if they can kind of functionally make it flex industrial.
We've done a few of those. We've done very big conversion in Beaver Creek, 95,000 square feet. We spend $35 a foot doing that, 35 probably bucks a foot just doing that. Do you see a lot of those conversions going on coming back to fruition, or it's still only ones and twosies?
I would say they're slowly happening. I think it's still that question of are the sellers that motivated? Is there enough? Are they that close to the finish line of like, okay, I'm going to have to hand back the keys? Or are they still holding on for dear life and you're still going to pay $100 a foot for nearly vacant single-story office building, and then you're going to put $35 a foot into it just to reconvert it? Those are the nuances, I think, of what we're probably going to see this year. It's they've been stretching themselves thin for a long time, and I think that there's going to be more of that. I haven't seen, we're starting to see offers on larger suburban office deals as well to fully convert.
Single story or multi-story?
Multi-story, and yeah, there's still been that demand driver to build more, even through everything, especially kind of in the Chicago suburbs. So anything that's struggling or could be bought that's kind of north of 7 to 10 acres, there's still interest out there.
Interesting, yeah. One of the challenges with a single-story office that we faced, we were able to overcome it, but it's a low clear height. Let's say, a lot of those single-story offices, they're still 10, 12 clear height, not 14, not 15. And one way to do it, just cut it up in a smaller base, but then it becomes very challenging to make it functional or drop the price. But sometimes you cannot drop the price because you have the bases, or maybe ceilings are too low and you can't attract anything. And maybe you've seen anything in industry, how people are solving that. We're contemplating raising the roof. I remember at one point, it's like $35 a foot again. You can raise the roof. But have you seen any tricks, know how to deal with that? Converting single-story offices to the flex spaces.
Well, I mean, I think, one, it's punching in some drive-in doors. I mean, can you necessarily, if you don't want to spend that additional money, but at the same time, if you can find a building that is the roof, these vintage products that are, the roof's already at the end of its lifespan, it's way more capital intensive.
And you meaning raise the roof?
Yeah. I think that's ultimately, if I were to buy a deal today, I would do that because I know the appreciation is going to pay out in the dividend. I mean, why just put a new roof on it? I might as well extend that opportunity to raise the roof, have better opportunity for those future demand tenants, and punch in the doors as you need them. Or find, we see some buildings that have, it's a little different in some of the Midwestern markets, especially in Chicago. But I mean, you have a lot of vintage product in Chicago and a lot of stuff that, functionally works the way those, my favorite type of property is a U-shape.
Yeah. Oh, yeah.
I mean, so you have some of those that are still office and need to be converted at some point. I mean, they have the perfect layout to have kind of a truck court and do that. So, I mean, if you can get, 14 to 16 foot clear minimum on those and push higher rates by still keeping some of the office, you don't have to peel it back. I mean, I think that's a good in between, but that also adds to your basis.
Yeah. Raise the roof and conversion, that's probably $60 right there.
Right. And I mean, maybe we'll see some change in where those pricing costs come in. Fingers crossed. I know that's been a huge hitter on a lot of these things. So, I mean, I'm hopeful for that. I think it would really recreate kind of a new age of the same product where you still have the brick facade and or, tilt wall, not just building new metal buildings.
Exactly. Yeah. Well, you can build in Chicago metal buildings.
Yeah.
Either new kind of, or conversions, one or the other.
Yeah.
All right. One more thing on office. What's your take on office to residential and conversion? There's a lot of buzz projects I've seen that it seems like people are still getting on them. What do you think the future office conversion to residential in downtown?
Good luck.
Okay.
Please
unpack it.
I think for me, I've looked at a lot of deals like that. I've underwritten a couple deals like that. I think it can make sense in various ways, but to me, I think it's a long-term battle. I mean, you still have to get people interested in wanting to be downtown again. And to spend all that money, even just from high level, I mean, take out the real estate, the location and the functionality. I mean, you have to fix what's there first before you spend that money. And then what are you charging compared to, you saw the 2015 to 2019-ish, that kind of urban to suburban migration. So we're saying that it's reversing now, but is it?
Reversing.
It is reversing, but have they done enough downtown to really draw people to want to be there? And are they making enough money to even afford it?
Yeah.
Because those rents are going to have to be extremely.
What I want to be clear when I say reversing, it seems like, people moving more to suburbs than I think that's, reversing other way around,
Yeah, I think
the theory I heard is
flipped.
that millennial is the biggest generation right now. And they hit, I think, medium 33. That's where they form families, and that's the peak when actually they move into suburbs. That's what keeps happening the last couple of years. And supposedly that should be ending, next 5 years, but who knows, right?
No, exactly. I mean, and that was 10 years ago when that was the first version of that. And then when it should have been happening more is when COVID happened and the whole downtown kind of shuts down. And so you're missing that mark, I think, on the generational desires there and them having kids and needing to be closer to schools. And so does it make sense? Sure. If you can buy a building for $20 a foot and make the numbers make sense where you can actually put in significant amount of dollars and still get a decent rent and people can afford it, sure.
Yeah.
But
Yeah.
those are tough too. You have to have some level of affordable, the sign-offs there. Maybe you get tax credits, who knows? But
Yeah, 100%. Yeah, those heavy lifts, that's an interesting beast by itself. And besides the capex and rezoning, I'm referencing Beaver Creek property where we had to rezone completely to do what we needed to do. And it was a year of this thing, which was a nightmare.
Yeah. And so you're talking about like a year, maybe two of just that. And then you have to do the build out.
Mm-hmm.
And then during that, maybe you're doing
Lease up.
pre-leasing.
It turns to a 5-year project.
5-year project, and you're competing against every other building that's maybe updating, renovating. Everything's changing too. Like technology is changing so fast. How are you going to keep up with what those demands are, even in the multi-tenant like multifamily space? Like that's tough.
Yeah, for sure. All right, so one more question on opportunity. Thank you for guys looking more tertiary markets if core market is hard to come by on deals, and when it comes to industrial and flex. But let's say office. If you're right, I see the office is about to bottom, or I still can snack some deals. If you're an investor, what's the playbook? Hold and wait, or position to flex and exit then? What's really the playbook you think you would be most advantageous for this year?
So if I owned office, like what would I do? Depends when I bought it, what the price point is, but I would say I'm a big believer in adaptability and continuously recycle. Like, I mean, if I would have stayed with office as my only deal type for my whole career, I would be struggling, like being a little adaptable, being willing to kind of, maybe you missed the mark. I would sell it and verify your portfolio with like multiple different product types to kind of set you up for success. And if you want to go back to office, there's still going to be a time to go back. Like it's still going to be there with some low basis opportunities for a while. I think try to go in while some of these other product types are ramping up so you don't miss out on it again and want to go back to that's what we saw. Everyone was like, I want to get into industrial as office failed. Now it's like, okay, if you then you're a firm believer. For me, I think pick your best prizes, and if you want to hold on to those, hold on to them. But I would say go out there and try to find some other opportunities to diversify your portfolio, and you'll be able to have more money to allocate either to the existing office deals you have, or reconfigure that and re-strategize from there. Don't hold on to something that's dying.
Makes sense. Well, Paige, there was a lot of value. Typical last question I have a pass if you don't want to, but it's what we call a personal question. So, and it goes like that. If you could sit down with 22-year-old Paige and you're just starting in commercial real estate, what would you tell her?
Just keep going. Just keep finding something new. You will, there's a ton out there. There's a ton to learn. Just keep your head up and keep going.
Awesome. Amazing. Thank you very much, Paige. For the listeners who wants to find you, if they need to sell the property or to get in the market where you're at, where can they find you?
Yeah. My email is pgunn@sig. Feel free to reach out to me online.
Awesome. Thank you very much, Paige. Really enjoyed it. Thanks for your knowledge and wisdom. And I'm looking forward to do it again soon. Thank you.
Yeah, likewise. Thanks so much.
You've been listening to the Value Builder Podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.